So my first step usually when beginning to look at any investment is simple Google searches, sometimes YouTube videos, although lately they're getting way too clickbaity to be reliable in my opinion. But let's just begin with this article. These are kind of the names you're going to see when it comes to dividend-focused ETFs. In fact, this is labeled the best high-dividend ETFs. So we got VYM, classic, HDV, that's lesser known, but okay. SPYD, that's a very well-known dividend ETF. SCHD, one of my faves. SPHD, not one of my faves. And VIG. All right, now the next step is to take one of these, like HDV, and look into the actual ETF itself. It's always good to read the investment objective, make sure it's congruent with what you're trying to do. So the iShares Core High Dividend ETF seeks to track the investment results of an index composed of relatively high dividend paying US equities. We can scroll down, look at its past performance, all that kind of cool stuff. But really the main thing here, aside from the objective, is the portfolio, because an ETF is just a basket of companies. So are these good companies? So we got the weighting over here. This is the important thing to look at. And then, of course, the company itself. So we can see up top, the heaviest weighting here is ExxonMobil. Okay. JP Morgan, Johnson & Johnson, Verizon, More Oil, P&G, Merck, so on and so on. We can flip through the pages here. Overall, I mean, they look like decent companies. Broadcom, one of my faves. Amgen has a very fast growing dividend, solid company. UPS, 3M. You're going to see a lot of these names across most of these ETFs. But for this one in particular, I'll just mentally note that oil is represented kind of heavily in this particular ETF. The next thing I like to do is to take a deeper dive into its performance and compare it against its competition. Let's actually pull it up first in Seeking Alpha. This is one of my favorite resources to use. And let's just look at dividends right now. So sticking with the iShares HDV, we can see they have a yield of 3.5%. I always take a look at the dedicated dividend growth page, and this shows you the annual payout growth year over year. So this is how much the dividend is changing year over year. And we can see it's 9%, 5%, 3%, 11%. So it kind of gives you an idea of where that 3.58% dividend yield is kind of heading in the future. So the yield is nice. The years of growth is kind of shy, and the growth rate was kind of all over the place. So, okay, another data point. Let's take a look at the price performance. Once again, I'm still looking at HDV just for this example. We're looking at the 1 year. Okay, looks okay. Let's zoom out more to get a better idea of what's happening. The 5 year. So we can see in normal times, it really doesn't appreciate that much. But when anything happens like a dip, it dips hard. And if you bought at the top, like most people tend to do, you're only just making your money back now. You're 1% in the green over 1 year later. And that little comparison is important to keep in mind because this is bound to happen again in the future. And are you going to be able to hold this when it's in the red for over a year? So important to note. We can also compare this to like other stuff. So let's go SPY, see what's going on with this. So in comparison to the general market, the S&P 500, we can see that this ETF has quite severely underperformed. If you go to the past year and kind of look at it more zoomed in, you can see the difference. Of course, this has a yield that's twice as high as the S&P 500. But still, this is the relationship. So after looking at all this stuff, the holdings in the company itself, the history of the dividend, and the price performance, I can say that HDV isn't my top choice. Coming back to this list, an ETF that I really do like for dividends is SCHD. I think that is one of the best. So let's do the same little comparison and see why this one is distinctly better. Okay, so the objective of SCHD is as following. The fund's goal is to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Dividend 100 Index. Okay, so it follows an index, pretty basic. You can read some more of the highlights here if you want to, but now let's go and look at the portfolio and see the actual holdings within this. Once again, the percent of asset is very important, and then the asset itself. So here we can see it's a little bit different. There's going to be a lot of overlap, of course, they're dividend paying companies, but we can see just kind of how it's made up more. And we can see up top, Home Depot, IBM, Pfizer, BlackRock, Amgen, Pepsi, Texas Instruments, 3M, so on and so on. And to me, I've researched a lot of these companies. I kind of have a background to pull from. And in my opinion, these overall are much higher quality companies. Like Home Depot is just a great company. They make a lot of money, high cash flow, and they're growing their dividend like 15% year over year. And that whole logic applies to basically all of these holdings, maybe except IBM. Not super enthusiastic about that one, but overall pretty solid, right? Now let's look at the history of the dividend. So right now the yield is 2.71%, not super high, but now if we come and look at the growth of the dividend, we can kind of see what's been happening. And overall it's been around 9, 10, more recently around 17% growth in that dividend year over year. So that's pretty solid, much more so than the last ETF. Coming over here and looking at the performance overall of this ETF, we can see it's been pretty solid. Zoom out more to the 5-year to get a better sense of what's happening. And something I want to point out here is that during that last market correction in March of 2020, yes, it went down sharply, everything did, but you can see that it recovered much faster. And even if you bought it close to the top, you are now in the green by 33%. So it has performed a lot better. And just to be fair, we can compare it against the general market, throw up that line, and we can see that it is lagging behind the S&P 500, although when you take into consideration the 3% dividend yield, SPY only has half of that, it's much more comparable. But overall, you can see that it's much more in line with the general market, even passing it sometimes. And the whole time, it's providing you with a much heftier dividend that you could be reinvesting and having better and better compounding. So generally speaking, this is my thought process when looking at different just investments to go into. In this case, it happens to be dividend ETFs. That's kind of how I judge what's good and what's subpar. So if you want my opinion, based off of my process I just showed you, I like SCHD. It's very popular, not just with me, but also in the dividend community. You can go to Reddit and go to dividends and you kind of see what the community talks about. And a second great traditional dividend ETF is by iShares, and it's DGRO. When looking at the 5-year, you can see that overall it's been doing pretty good, solid growth. It is focusing more on the growth of that dividend versus current yield, and that's being reflected in the stock price. Something to note is that this ETF has a lot of holdings, but the holdings within this ETF are very solid. Apple and Microsoft are 1 and 2, so it kind of resembles the S&P 500 pretty closely, with that focus on not just high yielding companies, but companies with a growing dividend like Microsoft and Apple. All right, but now the main point of this video is I want to take a look at more interesting dividend ETFs, and that is, I don't think there's an official term for this, but it's like enhanced dividend ETFs. And usually what these ETFs are is that on top of having dividend companies within them, they have something extra that they do to generate more income and provide a higher yield, usually trading options based off of stocks that they hold. An example of this is JEPI. So JEPI has a lot of those same really great dividend companies within it, but you can see the yield here is super high, over 7% at the current moment. And the way that they go from that classic 3% dividend yield to 7% is that on top of those holdings, it's actively managed and the portfolio managers sell options to try to generate a higher yield. Ticker QYLD. This is one that if you go to r/dividends on Reddit, they talk about this one all the time. You can see the name here that it's the NASDAQ 100 covered call ETF. And it has a dividend yield of over 11% right now. So it's based off of the NASDAQ and they sell covered calls. And we can see, zooming out to the 5-year, the overall price performance of this asset. And this is why I'm not a fan of this. So of course it does have a high yield, 11%. So if that's consistent throughout the year, it's going to return you 11%. That's pretty good, right? The S&P 500 usually appreciates, I think the average is like 12% a year. So you're kind of locking that in. But the price history isn't great at all. It's kind of sideways, if not negative. So if you bought it sometime before the Corona crash, you are still down about 5%. So the total return isn't super solid. Of course, yeah, you're making 11% from the dividend, but then you got to subtract 5% of your capital that you lost. So that leaves you with a gain of only around 6% in this example, which is, it's okay, but it's not as phenomenal as that 11% might lead you to believe because of the history of the actual asset itself. So that's why I don't like this particular ETF, because The overall concept of enhanced dividend ETFs are great, but you got to make sure that you're not getting a super high yield at the expense of your initial capital. And that's why I like JEPI, because the dividend yield is definitely enhanced, but it's not necessarily at the full expense of capital appreciation. We can see that it doesn't have the longest history. It was only initiated about 1 year ago. But even so, just based off what we have, we can see that it has been appreciating quite nicely while providing you with that enhanced dividend yield. Another enhanced dividend ETF I really like is DIVO. You can see it on the screen right now. So the dividend yield, it's less than JEPI. It's 4.65%. So it's not alarmingly high, but it definitely is enhanced compared to SCHD. It's about 1.5% more. So that's very nice to see. And still, the price appreciation the past year, it's competitive. Zooming out to the 5-year, we can see that it hasn't done as well as the S&P 500, but of course you have a dividend yield close to 5% this whole time. So if we want to compare this versus QYLD, we can see exactly how it kind of looks. Blue is DIVO, the enhanced dividend ETF, and yellow is QYLD. And I like to look for that middle ground. So QYLD, of course, has a dividend yield more than double, but 4.5%, and in the case of JEPI, 7%, along with competitive capital appreciation, in my mind, is much better than just a high dividend yield while losing your initial capital. So to conclude, I love dividend investing. Cash flow is a super valuable thing. And when looking at ETFs to invest in, always look at the underlying asset, the objective of the vessel itself, and of course the trade-off between the dividend yield and the price appreciation. So when it comes to standard just basic dividend ETFs, I love SCHD and DGRO. Most of the dividend community knows about these, and they're great. They're basic, they're simple. But then if you want something a bit more spicy, the enhanced dividend ETFs that I like the most are JEPI and DIVO. These two ETFs have very competitive capital appreciation along with that enhanced dividend payout. So JEPI is around 7% and DIVO is around 4.5%, both of which are pretty substantially higher than the traditional dividend ETFs, but of course they have slightly less capital growth with that. And you could do something simple and just invest in all 4 of these and have a pretty solid diversified portfolio. And you can see that the overall dividend yield with these 4 just evenly weighted is over 4%. And in the past year, the appreciation has been 34%. So they definitely work together pretty well. This is very diversified and provides you with a lot of income. So that's the end of the video. Let me know what you think in the comments down below, and I'll see you next time.